Good afternoon and welcome. Thank you for joining us for today's webinar. It's the second in a series of timely webinars provided by the Iowa Soybean Association. My name is Aaron Putsey. I serve as Senior Director of Information and Education for the Iowa Soybean Association, and I'll be the host of today's conversation. Joining us today for What to Know, What to Do Now is Tim Bardole, President of the Iowa Soybean Association. Tim farms near Rippey. Also joining us, Bill Northey, Undersecretary for Farm Production and Conservation, U.S. Department of Agriculture. Richard Fordyce, Administrator, Farm Service Agency, U.S. Department of Agriculture. And Jeff Plaguey. Jeff serves as the Superintendent of the Iowa Division of Banking. So we're very pleased to have them joining us here this afternoon. The Iowa Soybean Association is driven to deliver for soybean farmers and the industry, and today's webinar is a direct reflection of that promise. We encourage soybean farmers who are participating on this call today. You can validate and activate your ISA membership. It's easy to do so. Just go to iasoybeans.com and click on How Can I Join ISA? It's located right there on the landing page of the website. Our conversation today is going to be divided into two parts. We're going to have 30 minutes for information sharing by our panelists, followed by 30 minutes for questions from you, the audience. If you do have a question through the presentation, and we've already received a few of them, so thank you, keep them coming. You can share them using the Q&A feature at the bottom of your screen, and I'll bring those questions to our panelists when we move into the Q&A portion of our afternoon together. So with that, let's get started. I'd like to welcome again Iowa Soybean Association President Tim Bardole. Tim manages a diversified farming operation near Rippey, Iowa, northwest of Des Moines. Tim?
Yes, and welcome everybody that is on, and thank you to our panelists that have agreed to come on and talk to us. You know, this is really the third webinar that Iowa Soybean has worked with. We had a marketing one, and then one just pretty much outlining what we do and all the different aspects of Iowa soybean. But in these times, the guests we have on this, I think, is really what farmers are interested in and needing to know, as at least on my operation, cash flow is an issue and what's going on. So we have some people on here that can kind of give you the answer right from the top. So thank you, Aaron.
Thank you, Tim. We now welcome Bill Northey, Undersecretary for Farm Production and Conservation with the U.S. Department of Agriculture. And I know all of us on this call today know Bill very well, and he really needs no introduction other than I will say that he was nominated for his post as Undersecretary in 2017, confirmed in 2018. He does farm in northwest Iowa near Spirit Lake and served as our Secretary of Agriculture in Iowa from 2007 through 2017. So, Bill, welcome to today's discussion. I'll turn the floor over to you. Thank you.
How about if I unmute myself? Do I sound better now? Thanks, Aaron. Thanks, Tim. Glad to be with you. Thanks, everybody, for joining. Look forward to the discussion as well. I also have Richard Fordyce that'll be on, that'll talk a little bit about some of the FSA programs. But let me just take a couple minutes and what crazy times we live in. What a challenge for all our producers, the food system, consumers, everybody out there. It's certainly been a challenge for us to figure out how do we best respond. What are we needed most to do? And as you look across USDA, it really is a combination of many activities. Obviously, we think about our meat inspectors that are in our processing plants, in our export facilities, and making sure that all those folks are at work. So far, we have some issues in some of the meat plants, but it's not because we have a lack of inspectors. We have some issues in some of those plants because we're struggling to have all the workers be able to be at those plants. And then that creates a real backlog as everyone knows, on the animals that need to be harvested at those facilities as well. But it is the balance of the food system. It's making sure that they're there for our specialty crops, other things. Just one of the issues that came up was repackaging from food service to consumer-oriented grocery store availability. So you had something that was packaged in a way that could be sold at a food service or at a school. Perfectly good food. We're starting to run short in grocery stores, not able to use it there. And so USDA did some work to make sure that we could allow some variability in some of those labeling requirements for some of that to be able to get in stores. We've looked internally at a lot of our own processes and where can we be more flexible. I'll let Richard talk to loan programs for some of our deadlines as well. But within some of our other agencies, rural development, food nutrition, a risk management agency, that's part of our mission area. So you may or may not remember our mission area is Farm Service Agency, so farm programs, those county offices, our NRCS offices, they're out in all those counties as well. And then risk management agencies, which is run by private insurers. And we set up the rules around that. We've adjusted timelines. We've looked at, for example, some producers were not able to deliver all their milk, and that milk could count towards a dairy revenue program. We have other ways of looking at what are the flexibilities in the program that maintain the value of that program and the responsibility of that program, but allow some flexibility for folks that are in a situation that they would have never imagined. There have been questions. If a producer can't get planted this year because they personally have coronavirus, are they such that they can get a prevent plant policy payment for that? And we are not doing that. We've not done that in the case of lack of labor for harvesting specialty crops. And so there are some pieces that if we were to change those, we'd change the whole definition, certainly the rating of those policies. These are weather-based policies, natural disaster-based, weather-based policies, not economic challenges. It's whether you can't get into the field, like 19 million acres last year that we paid on, not whether you're not able to because of labor issues, either this year or other years. So there's some pieces of flexibility we can do, other pieces that we have real challenges with. Let me look at some other pieces. Richard will talk about signups like ARC PLC and with Plus that are still going on. Let me mention one other role certainly we think we have is making sure that we're advocates for agriculture in the balance of the federal government, whether it's around H2A and the availability of workers. It's not really right in our wheelhouse. We don't have a role to play on H2A, but we work with labor, work with Homeland Security to be able to make sure that there's H2A laborers because agriculture is essential. And although it may not have seemed like a big deal to someone in an embassy someplace, whether they that they get somebody to the U.S. and that there was even a risk involved, it was going to not allow harvest or other work to get done. And so the advocacy of that hasn't freed up everybody, but has certainly made it a lot better to be able to get some of those folks here. And then PPP, the program through Small Business Administration, working with them as well, make sure there's as much availability for ag producers. Even how they treat H2A, we may or may not win all those discussions, but we're going to advocate trying to understand the agricultural pieces. Last piece, let me say we are really concerned that we may back up some livestock in some cases. We will have some guidance out of NRCS about what to do if there's some emergency euthanizing of livestock and how to handle those in the appropriate way, as we did with some dumping of milk. not something we ever want to see, and something that we hope is extremely limited. But folks need to be able to have those resources. We'll even have some cost share available to help folks. Will not pay for the animals, but it would pay for some of the costs of disposal and composting and other things. So let me stop there, Aaron. There's a lot of things that folks need to say, and I look forward to questions. Thank you.
Thank you, Bill. And as we prepare to welcome Administrator Fordyce to our conversation, another former State Ag Secretary, by the way, I'd like to just remind all who are joining us today electronically, you can submit questions for the panelists, and at about the bottom of the hour, we will transition from prepared comments from our guests to the question and answer session. So we have received some questions already. I will be adding to those as we continue, but please, as a question comes to mind, do share it using the Q&A feature there at the bottom of your screen. Richard heads up the USDA Farm Service Agency, and he's also well-versed on our business of soybeans and row crops. Prior to assuming his current role in 2018, with the FSA, the fourth-generation farmer from Bethany, Missouri, served as director of the Missouri Department of Agriculture. He has also held leadership roles for the National Biodiesel Board, Missouri Soybean Merchandising Council, and served 11 years on the United Soybean Board. Welcome, Richard, and thank you for being part of our discussion this afternoon.
Well, thank you, Aaron, and Tim. You know, I spent some time with another Bardole on the United Soybean Board for a number of years. Certainly cherish that relationship and that friendship for sure. You know, before I make my remarks, Aaron, I'd like to say that the organization of this meeting was fantastic. I was a little nervous about the Zoom connection, and your folks made that just really easy, and really appreciate that. You know, this video conferencing concept, we utilize it, the Undersecretary and I and others see one another a lot. They're doing video conferencing, and certainly this is a great vehicle to be able to communicate, although we would much prefer to do it in person if the situation were to allow that. You know, I think certainly the Undersecretary framed the overall discussion about I guess USDA's posture, and I'll talk more specifically about Farm Service Agency. You know, from the very beginning, the Secretary, Undersecretary Northey, and myself, you know, knew that there was going to certainly be a need for continued customer service and that customer interaction, albeit not in person, to be able to continue to deploy the work that we do in loans, the work that we do across all of our programs at FSA, and so we changed status, you know, a couple of times as the coronavirus continued to be more prevalent and more present across the country. First of all, we were doing some screening of our customers coming into the door, and then ultimately took a posture of we will have some folks in the office, we'll have some folks that are working remotely, and not allowing customers to actually physically come in to the office. And we've just got dozens, if not hundreds, of success stories, innovative ways that our staff have come up with to interact with producers in a whole bunch of different ways. We have adopted some newer technologies for the ability to interact, to be able to get signatures on applications, whether that's programs, whether that's loans, and the ability for us to continue to provide that customer service that has really been the hallmark of Farm Service Agency, and certainly the other agencies within our mission area. And I know, you know, you've got there in Iowa, you've got a tremendous leader with Amanda DeYoung serving as the state executive director, and we receive a lot of updates from her on progress and ideas about how we can improve that customer service experience, not only for our customers, but also for the folks that work in those local county offices, you know, across the state of Iowa. when we think about kind of programs and loans, you know, one of the things that we were asked by the undersecretary and the secretary were to look at what places can we provide additional flexibilities. And so, you know, certainly, you know, a lot of our interaction is based on forms, on signups, those kind of things. And, you know, and historically, this agency has not teleworked. And so that relationship was always employee across the counter to a farmer or rancher, one of our customers. And so looking at ways that we could receive electronic signatures and have an interaction that was not based on a personal, you know, one-to-one relationship. And so we've adopted some new technologies that allow for a better transition of those documents from the agency to the producer, and doing that electronically and remotely. From the program side, you know, we've done some things that really were just policy based and certainly not statutory. We cannot alter, you know, provisions within our programs and loans that are statutory, but those discretionary things that were around policy, agency policy, we've looked at literally every one and tried to determine what it was that we could do. And so I mentioned the electronic signature approach on most everything, both on the program and the loan side. There are some legal documents in initiating loans that still require a wet signature, and we've even come up with ways to be able to facilitate those. When it comes to program sign up, you know, we're gonna offer as much flexibility as we can. And again, as we have additional sign up deadlines coming up, for example, ARC PLC for 2020, the sign up deadline is June 30th. We see literally daily progress on 2020 ARC PLC signups, so we know that activity is happening. WIP Plus, we added 2 new eligible causes of loss to WIP Plus for 2018 and 2019 a few weeks ago, those being drought and excessive moisture. That activity is happening, you know, around the WIP Plus sign up. Not a deadline per se for WIP Plus, but certainly we monitor that on a daily basis to follow the progress around that. We've even had conversations. We've had a team, and we'll continue to have a team from the field to talk about upcoming deadlines. What's the progress, and what can we recommend to the undersecretary, and maybe even in some cases the secretary, in extending some deadlines. And certainly, you know, I think we've got our finger on the pulse on progress and what's going on in the countryside around those deadlines. And so I would leave that that segment of my remarks to know that we are watching this, monitoring it. We're having conversations about those sign-up deadlines, and we will adjust as is appropriate. We've already had conversations about acreage reporting. Certainly, acreage reporting deadline is July 15th for most crops in most parts of the country, and we've had folks talking about that. How can we prepare the agency if we're not back in the office full time and not allowing producers in the office? How can we take those acreage reports? And we'll have some guidance, you know, coming in the future about how to be able to do that as well. So from the program standpoint, I think that again we're looking at every program, every deadline, and trying to do what's going to make sense for our producers, farmers and ranchers out there that rely on these programs every day. From the loan perspective, again, some additional flexibilities around signatures and other things. I mentioned that earlier. Where electronic signatures can work, we're going to do that. There are some guidelines around application time periods. We're offering flexibilities around those application timelines as well, and other things, whether it's appraisals and those sort of things. Again, just I think figuring out how we can continue to conduct business with some of the constraints that we're operating under. And I would, I guess, end my comments by saying that, you know, we've got a great team at Farm Service Agency, really from headquarters, state office, down to the county offices, that are completely embracing this operating status, have really helped leadership in a lot of cases come up with new and innovative ways to participate with producers. And we continue to adopt some new things, and we're literally learning as we go. And then finally, again, we're open for business, just not for personal business to walk into the door. And so I would just encourage everyone that's on the meeting today, and also Iowa Soybean Association and others that are on, to continue to tell folks, if you have a question and you call the office, someone is going to answer that phone, and continue to provide that assistance and customer service folks have been accustomed to for so many years. So Aaron, with that, I'll yield my time to the next presenter, and look forward to questions. Thank you.
Thank you, Richard. And we do have several questions that have come in during your remarks, and we'll share those in just a bit. Again, for farmers and for all who are participating, if you do have a question for any of our guests, please utilize the Q&A function there at the bottom of your screen. We have several questions that are coming in, so thank you very much. And I know that's what such a meaningful part of these webinars is, the Q&A. Before we get to Q&A, I do want to welcome our additional guest, our fourth guest here today, and that is Jeff Plague. Jeff serves as the Iowa Division of Banking Superintendent. He was appointed by Governor Reynolds to this post last September, and during his 41-year career in the banking industry, he has served as president and CEO of 3 banks, most recently Northwest Financial Corp of Arnold's Park. He is also chairman and of the American and Iowa Bankers Associations. Jeff is a former board member of the Federal Reserve Bank of Chicago and past chairman of the Chicago Federal Reserve Community Depository Institution Advisory Council. He's a native of Latimer, Iowa, received a bachelor's degree in agriculture business from Iowa State University, and is a graduate of the Graduate School of Banking at the University of Colorado Boulder. Welcome to Administrator Plague. We're glad to have you with us today. Well, we are going to work on Jeff's connection with us here this afternoon. As we do that, let's dive into a couple of questions. We have a question from Brent, who farms in north central Iowa. Brent asks, can you explain the difference between the small business loan and some of the other options that have been offered? Knowing these guidelines will be helpful to ensure eligibility before applying. Doesn't want to face a penalty for applying for the wrong type of loan. So again, that question comes from Brent in north central Iowa.
And either Richard or I can try to do that. Certainly, I'm not familiar with all the pieces of the PPP that Small Business Administration is delivering. There is eligibility for farmers there. I have heard the question of, does somehow participating in that negate the possibility to participate with Farm Service Agency on a loan, or participate with whatever kind of economic response there might be based on those dollars that came to the Secretary, the $9.5 billion or the $14 billion to top up CCC. And Richard, you can weigh into the piece on FSA loans. I don't believe there's any interaction here on having to choose one versus the other. We also do have some loans, I assume they're not talking about in rural development, because those are really not farmer-based loans. Those are other small business loans. I assume the conversation is here about those PPP loans. Loan forgiveness thing. Richard.
Yeah, Bill, I think you're right. One of the things I think that is being explored is those PPP loans. There's a component of that if you comply with the requirements of those loans, that there's a potential that they're forgiven, which would be deemed as income. And so the only thing from our perspective would be a potential it may impact adjusted gross income and that, that eligibility piece. And we're still digging into that. We actually, because of the importance of this, and I don't know if the Undersecretary mentioned this or not, but there is a designee out of the Secretary's office that's working directly with Small Business Administration from USDA's perspective to get a better understanding of kind of some of the components of the SBA involvement. But the Undersecretary is correct. There would be nothing that would preclude you from eligibility for FSA programs while participating in the SBA loan program, unless it may be that adjusted gross income in a future year.
And it certainly would be a future year, because we look back 2 years for adjusted gross income. It's the average of the 3 years previously. So for right now, we're in 2020, it would be 18, 17, and 16 that we'd be looking at. So it'd be a future impact. And overall, I think in many cases, we're going to have some losses this year that are going to count against some income that may come. And I don't think you'd want to risk losing some income because it adds to your AGI. You want AGI right now. We're all looking for it.
Great, thank you. And we have additional questions that have rolled in, but I see that Jeff has also joined us, and we hope that we have some of the audio difficulties worked out here. So Jeff, welcome to our conversation today. Thank you for joining us.
Well, thank you very much. And I have been hearing all of it, so I don't know what was the issue, but anyway, glad to be with you today. I'm going to cover a little bit of just what you may have heard in the news is the CARES Act, and then a little bit on the PPP loans, which is the one that's really in the news. But if you think about the CARES Act, and this is separate from what's been announced by the Federal Reserve Main Street program, it's a $2 trillion act. 30% of that, or about $600 billion, goes to the consumer family side. These are the checks you're starting to hear about that are supposedly arriving not by mailbox anymore, but 25% or $500 billion is allocated for large businesses. 19% or $377 billion is the small business program, mostly the Paycheck Protection Program, which I'll talk about in more detail. 17% or $340 billion is state and local government, and the remaining 9% or $180 billion is public and health services. So the one that's in the news the most right now, and actually still some confusion out there as to the farmer eligibility and the farmer access to this program, is the Paycheck Protection Program. And as of that was allocated $349 billion, and that program officially opened on April 3rd. And this program has been a little bit like changing a tire on the car as it's rolling down the road. It is coming together in pieces. It's pretty amazing when the fact that it is literally only 2 weeks old, that they've already executed 1,035,000 loans for $247 billion as of the end of Monday night. So I'm sure that number now is approaching $300 billion. And again, remembering that $349 billion was the original allocation. There's discussions in Congress today and last week about another $250 billion for that program. And I'm sure that will probably get worked out over time. In Iowa, as of last night, 22,295 loans have been approved for $3.7 billion. So a lot of activity, a lot of people working overtime. The largest 7A SBA program in the history of SBA was $28 billion a year. So again, this is $349 billion in about 3 weeks is what they're aiming to do. So it tells you the work that's been done. And so the whole objective there is to keep people on the payroll for their companies, as opposed to having them flip off and go into unemployment insurance, with the idea that if they're still on the payroll and this thing starts turning around, this thing being COVID-19 and the economy, that your chances of getting business back to business faster is certainly improved because those employees are still on the payroll. So the business had to be in operation as of February 15th of 2020. The loans can be delivered through banks, credit unions, farm credit system, and a few fintechs that have been allowed in the last couple of days. Loans can be up to $10 billion, $10 million. They're 1% interest, a 2-year maximum term. And the whole goal, what you do is you calculate a business's annual payroll, you divide by 12, and you multiply that times 2.5. So essentially what you're doing is borrowing up to 2.5 months of payroll with a little bit extra for rent or mortgage interest or utilities is the kind of the basic program. Again, I'm using small business terms as opposed to how it might apply to the agriculture side. And then after 8 weeks, the applicant can apply for forgiveness of the loan. The bank or the farm credit system, the credit union then applies to SBA. And if at least 75% of that money has been used for payroll, the entire amount can be forgiven. Now, again, used for payroll in the sense of what did you have for payroll before and what do you have for payroll now? So the objective is that, you know, you're trying to retain employees. Strict guidelines on the payroll numbers, a lot of documentation around the payroll numbers. Nothing as simple as it sounds, and this would be the case in this particular one as well. And for that amount not forgiven, that will go for 2 years, 1% interest, no payments for the first 6 months, interest only for the last 18 months. The farmer side of this equation has been a really rolling piece of information. We got new guidelines just yesterday, I believe it was, or the night before, I can't remember, losing track of days, that said farmers are indeed eligible. The complication has been is how do you determine payroll? Most farms are really more of an ownership draw than they are a payroll system. We had some early farmers apply that actually did have payroll of their dairy operations or some type of other operations where there are employees on the books. And so you could calculate that fairly easy. The new rules talk about driving off the profit from a Schedule F or a Schedule C. They're using those kind of interchangeably between sole proprietorships and the ag sector. Those still yet to be defined because depreciation isn't included or anything else. And so, and obviously we also know what's happened to agriculture in the last couple of years and what that profit picture is on a Schedule F has been obviously complicated as well. And essentially, if it's 100,000 profit, you're eligible to that level. If it's 0, you're not eligible at all. And so again, there's still details to be worked out on that, and hopefully in the next few days we'll get more of those details. And the loans will be available through June 30th. Again, assuming that they keep the program funded going forward. The Federal Reserve has also come in behind that program now with a $2.3 trillion program. One of those components of that program is to fund these PPP loans. And the reason that's so important, I'm still CEO of Northwest Financial Corp up in Okoboji area, rolling out of that as I take on this role. We have done about 1,300 of these loans for $200 million in the last 2 weeks. And we are like a lot of banks, we're doing that off our balance sheet. And so sooner or later you start running out of your liquidity. So the Fed is coming in the back door and funding these through a direct kind of a discount window access, with the loans being the pledged assets for that funding. So it'll allow us to continue to go forward and do additional loans, which we still have a pipeline of demand for. Otherwise, we would basically have to just kind of say, stop the gate. And of course, what none of us know is what else is coming at us. We don't know how long this is going to last. And so we need to keep liquidity for other purposes as well. So my final comments would be this. I mean, this is unlike the 2008 crisis that hit. We went into that with the financial sector being somewhat of a mess, kind of completely all the way through, especially the large financial sector in Wall Street. This one is just the opposite. The financial sector and most sectors of the economies were probably as strong as they've been in decades, with some exceptions, obviously. And what it is, obviously, is a health crisis. And now we're trying to keep it from becoming a financial crisis. And it's moving quickly, of course. If it's a 60 to 90-day event, that's one thing. We can pretty much work through anything on that kind of time frame. If it's a 180 to 365-day event, it gets to be a lot more complicated for everybody on this call and everybody in the country. Obviously, some of the sectors that had already had extreme weakness already was the retail sector and some of the commercial real estate around the retail sector, ethanol, oil, ag in a lot of respects the last 3 or 4 years. And so, you know, it's one thing if you go into this kind of event strong, it's another thing if you go into this event a little bit wounded already, and that's the struggle of trying to sort it all out. Also, you know, even the Fed and the Treasury do have a limit. I mean, you know, I've just mentioned $4.3 trillion worth of programs. And, you know, whether if this thing goes past 90 days, do they have to reload that again? And what's that mean to individual businesses, let alone the economy as a whole? So with that, I think I will just end that. Obviously, the Treasury, the USDA, and the SBA all have pretty good websites for program details on things, and happy to get those to Aaron or somebody at the end, and they can forward them out. That gets you right exactly to the programs I just talked about. Thank you, Aaron.
Thank you, Jeff. And to pick up on that point, we will be offering a recording available of this conversation. We'll have follow-up reporting at iasoybeans.com. So please keep an eye out for that. And if there is any additional information that any of our guests would like to share for the farmer audience, please do pass those along, and we'll be sure to get those out to farmers. So we have a number of questions that have come on in, and I've been trying to bundle them as best I can. I think I'm going to go to a question that came in from a farmer from Kossuth County. Any chance that grain that has been put under loan, that interest will be waived when brought back? Anybody want to chime in on that question from Kossuth County?
Richard, why don't you address that? But certainly neither of us mentioned, I think, the 3-month extension on the marketing assistance loans too.
So, right, you're right, Undersecretary. As part of the CARES Act, there was language in there that does extend those marketing assistance loans from the historical 9-month period to additional 3 months to 12 months. Those continue to accrue interest, you know, for the additional 3 months. We have, at this point, we have not, those are still accruing interest, and those will, that interest will still be due at the end of those marketing assistance loans. So, I mean, that's the answer for today.
A question that came in
Aaron,
from, yes.
Certainly new loans that are taken out up until September as well will be 12-month loans. Folks can, of course, pay them off anytime before the end of that period. But if people want to, they now have a loan that's due in June. They can wait another 3 months past that original 9-month due date to pay that loan back.
Thank you. I will ask one more question that we've received in online here, and then I'm going to turn it over to Tim Bardole, who will have a question for the panelists. This question comes to us from a farmer from Northwest Iowa. How do these programs work for self-employed sole proprietorship farmer and wife? And I think that's probably a question I'm going to kick back over to Jeff.
Guidelines just came out literally last night or the night before, and they will be driven, instead of a payroll record system, they're really going to be driven off a Schedule F or Schedule C. And essentially it's going to come down to whatever the profit number is on that Schedule F or Schedule C divided by 12 times 2.5. And essentially if it's operational costs, that becomes the measurement on the forgiveness side. So of course, again, the challenge is, especially in the farm sector, with the kind of the last couple of years of thank goodness for MFP payments and so forth, some of those profit pictures haven't been too great. And so the multipliers aren't going to work into much of a dollar picture from the standpoint of that PPP loan. I don't know, and maybe Bill and Richard could talk about whether FSA will have other options coming through those network of programs that would provide loans as well. But the PPP is still a bit complicated, but farmers are eligible. That's the main thing we need to make known, and sole proprietors are eligible. That window just opened up for applications on April 10th. It wasn't opened on April 3rd. So that's the new group now coming through the funnel into the banks and so forth that are doing the program.
And as far as FSA and kind of COVID program activities, we have nothing now that gives us an authority to do a matching type of program for agriculture at all. I have no idea what a phase 4, so you'll know that the most recent, that $2 trillion program was what they call phase 3. The next is being talked about right now, probably sometime in May as a response. I have no idea what will come out of that program. We have nothing just like that that's specifically for agriculture, or no authorities that allow us to do forgivable loans the way the PPP is structured.
Thank you. Tim, I'd like to throw it over to you as president of Iowa Soybean Association. Again, thank you for joining us here this afternoon. Your question for our guests here today.
Yeah, I guess my question is, with the economy as it has been away from agriculture has been really strong. Agriculture has been suffering for several years, more this past year and a half. What are the chances of another MFP payment? Because grain prices, I have bags of corn in the field that we put in field at harvest, and no ethanol plant will take it because they're losing money. And what kind of things, not that I'm guess pleading for help from the government, because I hate help from the government, but I want to survive also. And I think there's a lot of farmers in kind of in that same position right now.
I appreciate that. Certainly the MFPs to address the trade issue. Those two MFPs, the first one in direct payments was $8.5 billion. The second one was $14.5 billion. We all know, although we have some trade agreements that address some of those pieces, we're not trading like we'd like to be trading. But really the impact now being looked at is really a COVID kind of response, both in the impact to trade, but in the impact to other things, including price drops in fuel that put the ethanol plants upside down, and there's all kinds of other policy pieces there too. And as well as livestock and other kinds of things. So what Congress did do in phase 3 is they did give the Secretary $9.5 billion to be able to address, with a lot of flexibility, any kind of agricultural request to support COVID, the challenges of what COVID has done to infrastructure, demand, other kinds of things. And then in July, there'll be a top-up of CCC, which is our Commodity Credit Corporations, essentially our bank, where we go to for our PLC payments, where we went for MFP payments, other things. That doesn't happen till then, although we have a small balance in that account right now. And I think the Secretary and President have made clear that they're interested in doing something with that 9.5, and another about 6 or 6.5. That would allow us to do some sort of direct payments now for producers all across the spectrum. That would be grain, it would be specialty crops, it's livestock, it's dairy, something to be able to help soften this blow. Now, that may sound like a lot of money, and it is, but compared to the losses out there, it's a small amount of money. And it certainly was a small amount of money out of that $2 trillion bill. You know, it was about 1% of what that $2 trillion CARES Act was. So both the Secretary and President have said we're getting close to announcing something that would be some sort of response. It may have several components to it. I think you'll see something in the very near future on that. It'll take a little while to get some of the programming done. We've got Richard's folks buried in all kinds of other things, but we're going to bury them again. And we're going to figure out how to do this without going into the FSA offices too, right? So we are looking at something. It is not enough resources. I probably get 8 letters a day of the different commodities, 8 to 20 a day of the different commodities that are seeing losses. I'm sure we have about 50 to 60 billion dollars worth of demand for that potentially $15 billion worth of money. It's not going to go as far as it needs to. We'd argue maybe MFP didn't always as well. Sometimes it did, sometimes it didn't. This one certainly will feel like less than what it needs to be. Congress is going to go back for a phase 4. I don't know whether that will include some more agricultural support and what kind of strings or what kind of opportunities they're going to provide with that. But I would not at all be surprised if they're much more sensitized to the losses within agriculture and that there may be some more resources come in that. But it would take more resources for us to do more after this. Thank you, Tim.
We have a question from Mark. Mark asks, I need to get several landowners' signatures for PLC updated yields. Will the deadline be pushed to allow time to gather those signatures?
So Aaron, let me address that in one way first. And if the operator is a 100% share owner, so if it's a cash lease, we have changed the policy to not require landlords to also sign those ARC PLC applications if the operator is a 100% share. If it's a sharecrop situation, and we understand that certainly is can be a hardship. Certainly there'll be some flexibilities around getting those in. So again, as I mentioned in opening remarks, that just a communication with the office, that the person that asked the question and others that are on the call, that is really critical. That our staff are understanding that there may potentially be challenges there. And there certainly is room for flexibility to get those signatures in. But again, just to reiterate, if it's a 100% share operator, we are no longer requiring those landlords to have to sign.
Jeff, we have a question that is coming from you from a farmer in Northwest Iowa. The farmer would like to know, would a beginning farmer that has low income still qualify for the paycheck program?
Yeah, again, it will be driven off the Schedule F. So they would qualify if there's income there to be driven from. Obviously, it's going to be a small number. That's the bottom line on all of this for kind of the sole proprietorship and the farmer, because of some income limits that are also applied to that. But the answer to the question directly is they would be eligible, and again, Schedule F will drive their eligibility amount.
And I think this goes to the similar line of questioning, Jeff. Most farmers ask this question, or most farmers don't show much for profit on their Schedule F due to prepaying expenses, purchasing equipment, etc. So how does it work on the PPP program if the farmer doesn't show a profit? Could they use gross sales, gross revenue?
No, they're going to require, and that's the difficult, because even another big factor that they didn't take into account is just adding back depreciation would by itself change that number dramatically. And so it is going to be required that even if the taxes aren't done yet for 2019, they have to formulate a Schedule F or a Schedule C. So it's just going to be a difficult matter. And it's why it's been such a complicated issue, because they've, initially they said eligible, but there was no rules. And then they said eligible, and they've tried to put together some rules. And now we're going back to actually talk to them about the rules they put into place and the impact of those rules. But again, it looks pretty limited to me for the ag sector from the PPP program as it stands now. And I would add one other thing. One of the things that have been back and forth literally 4 or 5 times, directors are eligible, directors aren't eligible. They finally came through with directors being eligible with some caveats around it. So I haven't given up hope yet that they may find a better path on the ag side, but it's not a very good one right now yet. So.